Ifrs Society Pakistan and Financial Market Association of Pakistan, we welcome you all to today's seminar. We will be discussing the way forward with respect to the IFRS 9, which is going to have a huge implication for financial sector in general and banks in particular with respect to their investments, their lending as well as their liabilities. So today's events sequence is such that we have arranged a technical expert who will be giving a presentation on the subject matter, and that will be followed by a panel of experts from the banking sector. We've taken on board the regulator, the risk takers, the risk control people, as well as the CFO, so that we can have an all-encompassing debate on the IFRS 9. Before we start, I will request Sayyid Hassan Raza to please come on stage and recite a few verses from the Holy Quran.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم إذا جاء نصر الله والفتح ورأيت الناس يدخلون في دين الله أفواجا فسبح بحمد ربك واستغفر إنه كان توابا صدق الله العظيم.
Thank you, Sayyid Hassan Raza. Before we start, I'll request President Financial Market Association of Pakistan, Mr. Wajahad Aziz Qureshi, to please come on stage and say a few words as the opening remarks for today's event.
Assalamu alaikum ji. Well, it's not our forum basically, because personally I at least don't know much about this IFRS 9. But anyways, first of all, I would like to welcome all the participants, and particularly special thanks to our trainer as well as the panelists who have spared time to provide us this opportunity to make an understanding or to learn about this new thing which is coming up. The little that I know about IFRS, it's about measurement and classification of financial instruments, and what it's going to add on top of what we already have in the form of IS 39. The difference that I could find, and we'll all would love to know what exactly it is, but what I understand is that it is going to move to projected losses instead of incurred losses, which we are currently following. So that's all what I know till yet. And after this seminar, I hope that I'll also be able to better understand this. Thanks again, and thanks to CFA Society, which took this initiative and provided us, FMA, this opportunity to join hands with. Thanks again, and I believe we should better have the trainer to start it. Thank you.
Thank you, Mr. Qureshi, for your words. Now I'll request Mr. Arsalan Khalid to please come on stage and give us a presentation on the matter. Mr. Arsalan Khalid is a partner with EY Fort Roads and Siddharth Haider. He's a chartered accountant by profession. He leads the accounting and advisory services at the EY. And he's also part of the National Accounting Standards Boards set up by the ICAP. So I'll request Mr. Arsalan to please take the proceedings from here.
Thank you very much for the introduction, and Assalamu alaikum, ladies and gentlemen, good afternoon. Just to clarify, if your brain freezes after this presentation, this is not because of IFRS 9, because of the temperature that has been maintained in the room. So, okay, what we want to cover in the presentation today is that, okay, can I have a slide changer or something? Yeah, thank you. So today's session, IFRS 9 is a very interesting topic, and I can talk maybe hours and hours around it because a lot of time I've spent with IFRS 9 in the last 1 year with some practical experience across the banking sector and also other financial institutions in applying IFRS 9. And the idea of this presentation is to take you to the concepts, the basic conceptual ideas behind IFRS 9 and how it differs from the current accounting practice, which is IAS 39, and what factors now will contribute more to the measurement and valuation of the financial instruments that the bank and other financial institutions hold on their balance sheets. What will drive performance, what will not drive performance, and what should be the approach towards measurement or maintenance of the financial performance for you as analysts and also the financial officers of banks. So the agenda is to give you to start with some background around the reasons for replacing IAS 39 with IFRS 9, and then we'll talk about the major components of IFRS 9, which is classification and measurement of financial instruments, and the impairment model for financial instruments, which is expected credit loss model for the loans and receivables. And then some aspects of similarities with the Basel regulatory requirements of calculating provisions and also the capital adequacies for banks, how this new model of impairment interact with the capital adequacy requirements and the calculations of Basel that takes place for calculating the capital adequacy ratios of banks. And then some very important thoughts around the governance and implementation challenges that we all should keep in mind while this journey of IFRS 9 continues. So starting with some introduction around the reasons for replacing IAS 39. IAS 39, I think, as many of you may be aware, was issued somewhere in 99 or 2000, and the standard remained in operation for good 20 years, 18, 20 years. But during the financial crisis, the global financial crisis in 2008, the IAS 39 was highly criticized, and so much so that it was believed that fair value accounting, which is driven by IAS 39, is one of the major causes of the crisis because it creates cycles of selling, distressed selling of financial assets. Because the banks have to measure the assets at fair value, the fair value accounting drives the treasurer and the traders to, in times of crisis, to sell down their assets on a very quick basis so that they can avoid the capital losses, and that creates further cycles of selling or distress selling in the market and panic in the market. So the fair value accounting requirements were highly criticized because there was no market at that time. So what was mark to market was a big question mark. So this is one of the angles which gained a lot of attention in media, that IAS 39 is a standard which talks about a lot of fair value, which creates an economic problem. Secondly, it was also criticized that IAS 39 requires provisioning against assets which are impaired when the default occurs. So banks wait till the time the problem is visible, and at that time they start making provisions against loan losses, which is too late, because it is inherent in the credit activity that you are aware that certain inherent losses exist in your portfolio. So why wait till the time that those losses are actually on the surface and visible to all, and then you start making a provision? So it's too late recognition of loan loss provision. So what happens in the crisis, and what also happened in 2008 crisis, that because of the economic downturn, immediately a lot of impairment losses were visible on the financial statements of banks and financial institutions, which reflected a very bad picture of the overall economy. So the question was, why those banks and financial institutions were not prepared or were not taking buffers in order to cope up with those losses which actually surfaced. So those provisioning regimes that existed at that time and currently also they exist requires provisioning to be made when there is an objective evidence of impairment, when their default occurs, which is too late or delayed recognition of credit loss. So this is also one of the very important criticism which was made on IAS 39. And then it was also criticized that the IAS 39 as a standard is a very complex standard, it's over complex, and it has certain assets which are classified in a different way. In some cases, you take gain on losses to the P&L. In some cases, you take gain on losses to the equity. In some other cases, you don't measure instruments at fair value and just keep them at amortized cost. And then there are reclassifications taking place between those categories, and the entities can play around those categories to manage the financial performance. And in that way, IAS 39 complexity provides an opportunity to the markets to manipulate with the accounting, and this is not transparent. So the over-complexity of IAS 39 was also criticized. And then the Financial Stability Board, which was constituted as a result of the crisis, and also G20, they actually had a lot of pressure on ISB, International Accounting Standards Board, to come up with a standard which is more simplified and which deals with the accounting of financial instrument in a simplified manner, easy to understand, and so that there is a little room for manipulation by entities to artificially maintain the performance. And a model which is more closer to the economic realities, which captures the economic realities on a real-time basis and not delays the recognition of losses till the time the crisis occurs. The work on the standard started in 2009, and the ISB took about good 5 years till 2014 when they came up with the new standard IFRS 9. So a lot of technical debate has gone into this standard, in the making of this standard, and a lot of input has been taken from global regulators, from accounting bodies, professional bodies, analysts, etc., in making of this standard. So this is a very thought about area in terms of the accounting. And finally, the standard was released in July 2014. In Pakistan, the standard has made applicable by SECP effective from 1st of July 2018, period beginning on or after 1st of July 2018, which means accounting periods ending on 30th June 2019 for companies which have year ends ending on 30th June, and for companies or banks, mostly, having year ends 31st of December. For them, technically, this standard is applicable starting from 1st of January 2019. But as you know, the central bank, the state bank, has a major role in any of the accounting standard, and especially the standard which deals with the loan loss provisioning. So the central bank has caused an impact study across the banking sector to understand the impact of this standard on the banks before prescribing any implementation date for the banks in Pakistan vis-a-vis IFRS 9. So as yet, IFRS 9 is not technically applicable to banks in 2019. And the State Bank, we will have Irfan Saab here to talk more about the applicability and the outlook of State Bank on the implementation date. So the standard has three major components: classification and measurement of financial instruments, impairment, expected credit loss model, and the third, hedge accounting. So in this session today, I'll focus on the first two components because the hedge accounting is not very much practiced in Pakistan banks, and therefore it's a very low impact area in terms of IFRS 9 application. So we'll focus first on the classification, and then we'll talk about the impairment model and how it is different from the current regime that we have. So the conceptual foundation of the classification and measurement is that there are two kinds of instruments. You can classify the instruments that you have in two major categories. One where the cash flows are highly volatile in nature, like equity instruments, or instruments like derivatives, where the cash flows vary high with the underlying, and the volatility of cash flows is much higher than any other bond that you hold. So for instruments where the cash flows are highly volatile, ISB was convinced that we should still be using a fair value model rather than a cost model for measuring those instruments. And for those instruments where the cash flows are stable, like lendings, like your bonds, etc., amortized cost or the cost basis is still considered as one of the appropriate basis to measure those instruments. So this is a conceptual foundation of the classification and measurement model, that instruments which vary in terms of the cash flows with the market, those should be measured through a fair value model. Now, this is somewhat a mixed model, that some instruments still measured at fair value and some instrument measured at cost model, which is something which was criticized in the case of IAS 39, that IAS 39 presents a mixed model where you measure some instruments on cost basis and some instruments on a fair value basis, and that creates a complexity and room for manipulation. And therefore, the FASB, which is Financial Accounting Standard Boards of the US, also had a difference with the ISB, that they wanted a full fair value approach, whereas ISB still believed that a mixed approach is technically more realistic and more is better to capture the economic realities that we have. At the end, I think we still have a mixed model under IFRS 9, that certain instruments are still allowed to be measured at cost, and whereas most of the instruments are allowed or required to be measured on a fair value basis. So there's more fair value arising from IFRS 9 than IAS 39, certainly, but still amortized cost accounting is allowed under certain conditions, and I'll explain in what conditions amortized cost accounting is allowed. So if you look at the current scenario, we have essentially three categories for banks where we classify financial instruments: held for trading, held to maturity, and available for sale. Held for trading are those instruments, as you know, which are held for a short-term trading purposes and where the intent is to make short-term gains rather than taking them for long-term gains purposes. Held to maturity, where you want to take a long-term view, don't have any intention to sell or to redeem the investments, and you have a commitment to hold them till maturity, and the rest is available for sale category. There is another category which is IAS 39, also allows you to categorize or to designate any of the financial assets that you have at fair value through profit and loss account, but that is not practiced or that is not allowed by State Bank because the accounting for investments is driven by the State Bank directives rather than IAS 39. Because as you know, IAS 39 is not applicable on the banks, but State Bank has issued instructions which are substantially similar to IAS 39 to deal with the investment accounting. So we have a regime coming out of State Bank to deal with investment accounting, which is substantially similar to the IAS 39 requirements, but in that regime we don't have this category which allows companies to designate any investment at fair value through profit and loss account. So we only have three categories left, but as you know, all these categories and the classification is based on the, by and large, on the intent of the management. So what is my intent while I purchase or acquire a security? And that intent is on instrument by instrument basis. That whether the intention is to hold that instrument for trading purposes to make short-term gains, or the intention is to hold the instrument till maturity, or to hold that instrument on a medium-term basis, and in which case it falls into an Ifrs category. So that is more of an intent, and intents are not auditable, as you know. So there is a room for management to play around the intent area to achieve a particular classification. And as you know, whichever classification you choose, it has an impact on your P&L account. So therefore, from an implementation point of view, that this mechanics is not very solid because it is based on the intent only. It is not based on facts, it's based on the intent of the management and willingness of the management. And those intents are biased in some cases with the motives to arrive at a particular P&L number. So therefore, this is the scenario that we have, but under IFRS 9, the classification of instruments is different, or the approach to measuring the instruments is driven by two things. One, whether you are dealing with equity instrument or you're dealing with a debt instrument. So the distinction between the nature of the instrument is very important before you come to account for it. In case of equity instruments, under IFRS 9, you can hold equity instruments either as held for trading or a non-trading portfolio. So either you have a trading portfolio or a non-trading portfolio. In case of trading portfolio, no change. You still have to carry a trading portfolio at fair value through P&L account, like you do currently. But in case of non-trading portfolio, say for example, you have a portfolio held for not short term, but from medium term purposes, you want to achieve a certain dividend yield out of that portfolio, or you want to maintain certain level of capital gains coming from those portfolios over a period of 3 to 4 years. And that is a non-trading portfolio that is not held for active trading in the market. Then you have a choice whether you want to carry that portfolio at fair value through OCI, other comprehensive income, or in other words, through equity, or you can designate that portfolio at fair value through P&L account. So this is a choice which is available on the adoption of the standard. So on the day one, you can choose to either select or either classify all your portfolio at fair value through OCI or at fair value through P&L. This is a one-time choice and irrevocable choice. You cannot switch between those portfolios going forward. This choice is irrevocable and wants to be exercised. Once you have done that, now this non-trading or fair value through OCI category is not exactly available for sale accounting, because the difference is, in case of available for sale accounting, what you do is, in case of disposal of gains, in case of disposal of securities, you transfer the gain to the P&L account or recycle the gain to the P&L account. In case of fair value through OCI category, IFRS 9 does not allow the recycling of gain to the P&L account. So the gain and losses which are recognized on non-trading investments held at fair value through OCI will permanently remain within the comprehensive income, within the equity, will never be recycled to the P&L account. And the reason is that, under IAS 39, you remember maybe in 2008, when there was a financial crisis in the markets of Pakistan as well, 40–50% decline was observed in the stock prices. Then, according to IAS 39, in case of available for sale investments, you take losses or gains to the equity, but if those losses are above a certain threshold, if there is a significant decline in the value of a equity security, then you cannot park that loss in the equity, but you have to take that loss out of the equity and transfer it to the P&L account in terms of the impairment. So there was a lot of charge to the P&L because the markets declined by more than 40–50%, and there was impairment in the value of equity securities. So it remained a matter of a lot of debate that what is impairment in the case of equity securities and what is not an impairment, because at that time, I remember a lot of people were saying that this is a temporary decline. The markets will come to their previous level in 2 years or 1 year time, And there's a reason why SECP also allowed some temporary relaxations from booking of impairment losses arising from 2008 market crash. But this was a global issue. Globally, no such relaxation was allowed, and therefore, banks had to book huge impairments into their P&L as a result of significant decline in the values of equities. Now, what is significant, what is this not significant decline, whether this impairment is temporary or permanent, is a very complex area, because what is the level of volatility that you expect in the equity prices? What can be reversed in the future? What cannot be reversed in the future? It is highly judgmental. And therefore, under IFRS 9, they removed this impairment transfer requirement, and the standard now says you choose on day one whether you want to route all your gains and losses through P&L account, or you want to route all your gains and losses through equity. You make that choice on day one. So in case you want to take all those gains and losses to equity, they will permanently remain in equity. They will never be transferred. Neither gain nor loss. It will all remain within the equity for all times to come. In case of, if you choose at fair value through P&L category and you want to expose your P&L to more volatility, then you should be prepared to take the losses to the P&L as well and the gains as well in times when the markets are booming. So banks have a choice on day one to classify their portfolio depending on how much volatility they want to be exposed to in terms of their portfolios. What we understand from our interactions with the bank, most of the banks wants to play safe. They want to classify all the equity securities at fair value through OCI rather than at fair value through P&L account. And in that case, the gains and losses will remain in equity, and you will not have that capital gain transfer to the P&L or capital gains realized in the P&L as you see in the case of many banks, which in some cases constitute a major portion of the P&L account. So that is a change which is going to happen once IFRS 9 is implemented. So the EPS will get affected. Also, there is a challenge in terms of the tax, whether this gain or loss will be taxable or not, because it is not reflected in the P&L account. But to me, I think that the taxman will tax anything which is a gain, no matter where it is sitting in the comprehensive income or the P&L account. So they will not leave that. So this will be taxed. And the third question is whether this amount which will remain in OCI will be available for dividends or not. So as per the law that we have, the dividends are allowed only from the profits for the year. And the profits means profit which are reflected in the profit and loss account. So there is no recognition of comprehensive income in the law in terms of the dividends. So technically speaking, maybe comprehensive income may not be available for dividend purposes, but in case of banks, it's not the component of the equity which is very important when it comes to dividend. It's the overall capital level which drives the dividend decision. So, okay, if you cannot take out dividends from the comprehensive income reserves, you can take out more dividend maybe from unappropriated retained earnings that you have, provided you maintain the capital adequacy requirements. So it does not make much of a difference in terms of the component of the equity that you're using to pay dividends. Rather, for banks, it is more important whether dividend is paid after they maintain the capital adequacy requirement, because this is a fundamental thing any bank would look before declaring a dividend or before paying out any earnings. So this is a change which is coming in terms of the equity portfolio. Also, there's another, unquoted equity investments. Previously, there was an exemption under IAS 39 that you can carry unquoted or unlisted equity investments at cost, less any impairments, but I think that is not allowed under IFRS 9. Unquoted in equity investments should be fair valued by all the companies, especially the banks and financial institutions. So you may observe that the banks, I think in very few cases they have some unquoted equities, but if they have to fair value them, and which may result in some earnings or losses as the case may be. Okay, in terms of the debt securities are broadly classified into two categories. One, which are really debt securities, which we call where the return is solely principal or interest. So you have a debt security where the return that is coming is only either principal that has been returned or the interest. And interest is defined as time value of money plus the compensation for the credit risk that you take, right? If you are receiving anything else, that is not a pure debt instrument. That is not a pure lending arrangement. For example, if you have a convertible bond, which can be converted into equity at any time depending on the options, etc. So the return that you're receiving is not exactly the lender's return, but it also contains an element of equity conversion premium. So it's not a time value of money per the credit risk, but also the equity conversion risk that you're taking on the instrument. So that instrument is not compensating you just based on principal and interest. It's not a basic lending arrangement. Similarly, in some cases, I think we do not have such instrument in Pakistan maybe, but the returns are linked to, say, commodity prices, gold prices, or currencies, etc. It's not based on credit risk, or it is not directly based on time value of money. So those instruments will not qualify as basic debt instruments. And then, if you have those instruments which are not qualifying as basic debt instruments, you have to fair value them in any case. So all those instruments which are not basic lending arrangements, which have to be measured at fair value. In Pakistan case, some companies or some banks have invested in tier 1 capital issued by other banks, and the tier 1 capital have feature of conversion in equity in times of some triggering events, such as if your capital adequacy falls below a certain level, then the holder will be required to convert those instruments into equity. So therefore, the price of those instruments, the return on those instruments, not equivalent to the principal and interest, but also the risk premium for the equity conversion situation is also built into those instruments, and that is why it may not qualify as a debt instrument, as a basic debt instrument. It has to be fair valued. So for all those instruments which are basic lending arrangements, like your PIBs, your T-bills, your TFCs in most of the cases, there are basic lending arrangements and loans and receivables that you have advances, because the return is either principal or interest, nothing more, nothing less. You can have some complex situation in case of restructuring. When the loans are restructured, then the returns are not linked to interest and principal, but are linked to sometimes the business earnings of the entity which has been restructured. In those cases as well, the loans will not meet the definition of the basic lending, but will have to be fair valued. So in case of those instruments which are pure basic instrument, you apply a business model test. The first test that we applied, whether or not those instruments are basic lending arrangements, and the second test is how those instruments, what is the purpose of holding those instruments, which we call business model test. Now, a business model for those debt instruments could be either hold to collect, something like held to maturity, but the difference is you just not look at the intent, but you look at the history. In time, in the previous years, how much of that portfolio was sold in times of need or liquidity requirements, etc. If not, then you can demonstrate through your business model that these instruments are hold to collect business model. And the business model, by the way, is not something which is based on some some judgment or intention of the management, but it's a matter of fact which is apparent from your business planning, your strategy documents, your budgets, your history, etc. So certain portfolios are kept to hold to collect. For example, the loan portfolios. The loan portfolios that any bank holds is for the purposes of collecting all the contractual cash flows. Because this is the business model of the bank. You can vouch for that business model for taking out the history of any bank, that the bank has not sold any of the portfolios, is not in the business of selling portfolios. Say in 1 year they have sold their auto portfolios to other bank or to any other investment bank. That's not happening. If this is not happening, your business model effectively is that you want to collect all the contractual cash flows arising out of that portfolio. Whereas if you have a liquidity portfolio, that, for example, you have a portfolio of debt instruments where you want to maintain a certain level of yield or return, and any security which is not giving you that desired level of yield, you will replace it with other. So you have a target yield that you want to achieve. So you're not in the business of selling or continuously trading that portfolio, but you will sell in times when you want to maintain your yield or there is a liquidity requirement on the bank. So typically, portfolios which are marked for liquidity purposes are held under the model which we call hold to collect and sell. So you have a business model to hold to collect but also sell in times of liquidity need or in times when your target return is not achieved through that security. This is a second category of business model that you can have. And the third category is simple, that trading portfolios, that you are holding that portfolio for active buying and selling in the short term in the market. So if you have three kinds of business models, and this business model is, so you can have different portfolios with different business model within the same entity, within the same bank. Because you can have within the same entity a portfolio where you want to collect all the contractual cash flows like your loans portfolio and credit portfolio. And within the same entity you have a portfolio which is maintained for liquidity need. And within the same bank you can have a portfolio which is held for trading purposes. So the business model is not at the level of the entity, the business model is at the level of the portfolio. And the business model is demonstrated by the facts, the history of the bank of dealing with those portfolios, and also the future in terms of the budgets, the business plans, and the strategy documents. So the business models are normally well documented already, so you cannot change them on the basis of the intent of the treasurer or management or ELCOs, etc. So that business model is a matter of fact. It cannot be changed frequently, and therefore it is more visible out of any entity, rather than an instrument by instrument decision which is made based on intentions which are difficult to challenge. So in case you have held to, if you have hold to collect contractual business model, then you can carry those instruments at amortized cost. If you have at hold to collect and sell model, then at fair value through OCI, which is like AFS category, and in case of trading portfolio at fair value through P&L account. So if you look at that business model and if you assess, it's not going to make much of difference to the current way the debt securities are handled by the banks. Because in most of the cases, if most of the security, the bulk of the securities are sitting in the AFS category. So in the AFS category, you have either, equity portfolios and also the debt portfolios. And for those AFS securities, you actually have to take a decision that what is the business model of holding this AFS portfolio, whether this is held for liquidity purposes, for the purposes of target return, short to medium term, etc. In that case, they can remain at AFS category. In case you think the business model is to hold to collect cash flows out of those portfolios, then they need to be transferred at amortized cost. Because the held for trading portfolio will remain substantially the same. So you need to take decision on the basis of available for sale portfolios only. In the available for sale portfolios, okay, there are a lot of banks, for example, which invest in, say, sukuks. Now, you have to ask this question that what is the purpose of investing in sukuks or bonds? Is it to achieve a target return? Is it to maintain a liquidity requirement which is set out by the regulator, that certain portion of your assets has to be in liquid securities, or you are just investing it for the purposes of collecting all the contractual cash flows like you invest in your credit portfolio's advances. So if the business model is the same, you're just using a different instrument, sometimes Sukuk, sometimes TFC, and the business model is that you want to collect all the contractual cash flows, you don't want to trade them in market, then in that case, those can be measured at and should be measured at amortized cost. But keep in mind that IFRS 9 is flexible in that way. It gives you a choice on day one, even in case of debt securities, that you can designate any debt security at fair value through P&L account. So that is a category you can choose on day one, but that is a one-time election. You cannot change that election as you go forward, because that will tantamount to manipulating the profits, because if you change those choices, for example, if there are losses because of the market situation like we have today, the interest rates going up, and there are mark-to-market losses on debt securities because of the interest rate scenarios, then if you are allowed to change your classification from fair value to the cost model, that means something which is not and appropriate in terms of accounting. And therefore, the designation at fair value through P&L account is permanent designation. So in case of losses, you have to route them through P&L account. In case of gains, you have to take them to the P&L account. So available for sale securities in our, in case of our experience, I think most of the banks are holding AFS securities either for liquidity purposes or for the purposes of achieving a target return that they have in mind, or a horizon of 3 to 4 years or 2 to 3 years. In that case, they can keep those securities at AFS. Okay, so this is an area of investment accounting. As you can see, substantially, it's a low impact area, except for equity securities where you will not be allowed to take the gain and losses to the P&L account on disposal. I think many of the accounting mechanics will not change, but the approach has to be documented in a different way, where you have to test the classification against your business model and requirements. So it's a change in terms of your methodology and in terms of the procedures and policies that you have, but at the end of the day, the landscape is not changing much. So let me now go to an area which is of high an impact, which is an impairment model, which is the heart of IFRS 9. And so in terms of, again, I think as I said earlier, one of the criticism on IAS 39 was the delayed recognition of losses on account of impairment in the credit portfolios. And what happens is that IAS 39 is a backward-looking model. What you do is that when you build up portfolios, you earn interest on that portfolio. You actually start booking interest income, and then after a few years, you identify losses in that portfolio in terms of the default, and then you start making provisions in terms of impairment against those portfolios. So in the times that you are building portfolios, your bank is enjoying the earnings, whereas the risk that you have taken is not reflected in your earnings. And after a few years, when the default or the risk materializes, then you start booking those losses abruptly, and that hurts the P&L account and give a surprise to the shareholders. And if you look at from a management point of view, in the West, it's very common that you are compensated heavily based on your earnings. The CEOs and the board, sometimes their performance bonuses are linked to the earnings. And this is a very dangerous model in that scenario, that in the initial years, somebody is building the book and booking gains, showing a very good picture of the bank and taking away the bonuses. And after 3 years, when the losses started to surface, neither the CEO is around nor the risk takers are around, and the new entirely set of management is dealing with those issues, which are the result of the decisions which were taken by the previous set of people. So you are taking, actually, this is not fair. So the risks that you are undertaking are not reflected in your performance, whereas those risks are taken from day one. So this is a model. There should be a model which should be forward-looking, which should proactively book provisions rather than just book provisions at the time the problems are surfaced already, and everyone is already aware of those problems. So the delayed recognition of credit losses is a problem, and that is, Irfan Sahab is here. I think that's the regulators around the world criticize that aspect, that we are recognizing impairments when the default occurs, when the world is already aware that it's a loss which has occurred. Where is the futuristic, forward-looking approach? You have to be proactive. Your provisioning methodology should be dynamic. What is the expected loss? That needs to be built in your provisioning rather than the history. So you have to build a model which should be on the basis of expectation of loss rather than on the incurrence of loss. Now, incurrence of loss, as I said, you only book provision when the loss has occurred, when the loss event has occurred, when the breach of agreement has taken place, when the restructuring event has occurred. And 90 days past due is a universal rule of thumb which is followed to measure the default event. We do not also capture sometimes the restructuring, because that is also an event of default in itself, but that also remains out of the scope of the impairment for some time, till the time the companies are in rehabilitation phase, etc. So we start capturing impairment, and we have a very aggressive formula of measuring impairment, that in case of default, you start making first 25% and then 50%, and within 1 year you make 100% provision with some advantage of collaterals. So this is a portfolio which has already defaulted, but what about the portfolio which is a good portfolio? Now the impairment requirement or IFRS 9 says, because we have to look at the bank on a holistic basis, and we have to make provision based on the credit risk that exists on the book rather than just the defaulted portfolio. So which means what you need to do, and you also need to look at the portfolios which are on balance sheet and off balance sheet, because we tend to ignore the guarantees that we have issued, the limits that have been given to the borrowers. Those limits will be utilized in times of difficulties and then will create exposures, credit exposures, which will also go into default. So the IFRS 9 impairment model not just apply to the on-balance sheet credits, but also the off-balance sheet exposure. Secondly, IFRS 9 says that impairment should be recognized over the life of the loan. As from the day you start disbursing the loan till it goes into default, you should have some reserves built up to cater for the inherent risk of credit. And so that when the default occurs, you already have some buffers in place to deal with the loss situation, and there is no sudden shock to the economy. So their earnings go in a stable direction rather than an high impact in times of crisis or financial difficulties. Thirdly, which other way which means that we are booking losses even before there is any impairment objective evidence available. So we are booking losses in advance of any impairment evidence. So this is the conceptual basis of expected credit loss model. Now, how we do it? The standard says you have to divide the book in three buckets, what we call normally stage 1, stage 2, and stage 3 bucket. Now, these stages reflect the lifespan of a loan. You know, in the initial year when you disperse a loan, it's of high quality in most of the cases, although in some cases you also grant a loan when the financial position or health of a company is not very good, and on day one it may be not a very high quality loan. So stage 1 is a loan which actually is a high quality loan with low risk of default. Then as you move with the loan, the borrower may face some financial stress situations, business impacts, etc. And the credit risk on that loan increases. That may be because of the external factors or internal factors, operational factors with the company, or market factors, economic factors, etc. Whatever they may be, they increase the credit risk of a loan. Those loans where the credit risk has increased from the time you originated those loans are categorized in stage 2 loans. So at the time you originated the loan, if your perceived risk was X, and now at the reporting date that risk has gone up, which means it is a stage 2 loan. The credit risk on that loan has increased as compared to the risk which existed at the time you originated the loan. So this is a relative comparison. What was the risk at the time of origination, and what is the risk that stands today? So stage 2 loans are by and large those loans which are not non-performing but are underperforming. Okay? So stage 1 high quality, stage 2 underperforming loans, and stage 3 are your NPLs, impaired loans, which we already have marked and have made a provision against. So you need to have your portfolio bifurcated into these three categories. For stage 1 loan, which is high quality, the standard says there is some probability of default on that loan. There is a chance that that loan may go bad, but you need to look only next 1 year for those loans, because it's not fair to charge those loans with a heavy provision on day one. So what you see, if you can envisage some defaults or some expected credit losses in the next 12 months, those needs to be booked on those loans. So you have to measure the probability of default in next 1 year, in next 12 months, what we call 12 months expected credit loss. So what are the chances? Because when you give a loan, for example, it's an auto loan, you have, say, 36 installment over 3 years. Every installment, there is a probability of default. But what are the chances of default occurring in the first 12 months? If the chances of default, say, on the entire loan over its life is 10%, for example, then maybe, and it's a 3-year loan, so maybe 3.3% is the probability of default occurring in the first 12 months. So the probability of default in the first 12 months is less than the probability of default, because the longer the span of the loan, the longer the probability of default, because the longer you are exposed to the exposure. So the first stage 1 loans, you have to measure what is expected as a credit loss in the next 12 months. In case of stage 2 loans, you have to measure the expected credit losses over the life of the loan. Okay? Whatever is expected as a credit loss over the life of the loan has to be projected. And third category is NPL, right? So stage 1 loan, the level of provisions is much less than as compared to the stage 2 loan, where the level of provision is much higher. And these are mostly your watch list accounts, mostly your accounts where the credit ratings are, say, 7, 8, 9, etc. And now, it is important, what the standard says is that you can apply a whole range of criteria to bifurcate between stage 1 loan and stage 2 loan. You need to look at the industry factors, you need to look at the operational conditions of the borrower, you need to look at the internal credit rating, you need to look at the external credit rating, you need to also look at what is already classified as watch list, etc. But there's a presumption that any account which shows an overdue of 30 days plus is a stage 2 account. Any loan where the overdues are more than 30 days is effectively a stage 2 account, which is, in other words, we are saying that the credit risk on that loan has increased significantly as compared to credit risk which was perceived on inception. Now, practically speaking, when you started talking to the banks, they said, I think in Pakistan it's very normal that the loans are paid on 89th day. Installments are paid on 89th day because everybody wants to take the credit or advantage of 90-day period before you classify any loan. It's not fair because we know from day one, this is not a reflection of the increase in credit risk. This is just an administrative and operational problem that we are facing. And therefore, 30 days credit DPD is not a valid reason to classify everything as stage 2, which is a valid argument. And the standard also allows that you can rebut this presumption if you have solid reasons of rebuttal. So what is then the basis or criteria that needs to be followed to classify a loan as stage 2 loan? We effectively said, and this is a practice that normally is followed internationally as well, that because these loans are not rated externally, we start looking at the credit ratings which are assigned internally. So every bank has a scale of credit rating from 1 to 10. So we say the credit rating is, different banks uses different level of sophistication and scorecards in making assessments about the ratings. But effectively, all the factors about operational performance of the company, market factors, etc., governance, financial performance are catered in that or reflected in the internal ratings which are assigned to the borrowers. So if there is a decrease in the rating or a downgrade in the internal rating, say by 2 notches or 3 notches, that means the credit risk has increased on that loan. So let's take that as one of the criteria for classifying your portfolio as stage 2, that where the bank itself believe that the credit ratings they have downgraded by 2 notches or 3 notches, which means the credit risk is perceived to increase significantly on that loan. Secondly, all those accounts which are rated 8 or above may be classified or considered as stage 2 loans. And all those accounts where, for example, are not past due by 30 days, but maybe past due by 60 days, etc. So and past due by 60 days, not at a year end, but if you look at the behavior, say they have passed 60 days twice in last 1 year, which shows a repayment behavior which is not very encouraging. So those factors on those criteria can be used to identify loans where the credit risk is increased as compared to the origination date. So if you classify those loans as stage 2 and distinguish them from the high quality loans that you have in stage 1, then you are geared up to calculate the provision on the overall book. Now, this is a classification in terms of the portfolio that you have made. Now, how to calculate the expected credit loss? It's easier said than done, because one way of doing it is I start, in case of corporate loans portfolio, I individually go and analyze cash flows of each borrower, then see what is the scenario, A, good scenario, bad scenario, likely scenario, assign probabilities to different scenarios, come up with the expected cash flow, and then say, okay, this is the expected credit loss, which is very cumbersome exercise. You cannot do it for all the corporate loans. So you have to segmentalize loans. You have to segmentalize loan into retail, into corporates, etc., and also segmentalize loan in terms of their credit rating. Within the corporate, you segmentalize loans, say all loans in terms of the rating, 1 category loans, 2 rated loans, 3 rated loans, 4 rated loans, etc. So now you have loans in different segments, and you can then start projecting what should be the expected credit loss under each category of the loan portfolio, or into each segment of the loan portfolio that you're looking at. What we normally use is that ECL is the product of probability of default into LGD, loss-giving default, and into exposure at default. Now, what is PD? Is the chances, what are the chances that a loan will go into default? This is factor one. The probability of default is what are the chances that that loan will go into default? The second is when the loan will go into default, how much loss you're going to incur, because 100% is not the loss. You will have some collateral, you will realize you will have some recovery, etc. So the second factor is when the loan will go into default, how much is going to be recovered through collateral, etc., and recoveries. And third is what will be the exposure at the time of the default, because the exposure may not be exactly the same as you have today, but there may be certain off-balance sheet facilities which will transition into your credit exposure at the time the default will occur. So the credit exposure, the future credit exposure may be higher as compared to the current exposure that you hold based on the commitments and based on the contracts that you've entered today. So the expected credit loss is a product of probability of default, loss-giving default, and the exposure at default. If you can calculate these three factors across your loan book, you will be able to calculate the expected credit loss. Now, the first factor, the probability of default, how we measure probability of default. The probability of default, normally what we do is we go into the history and we also look at the future. How we see the history is that we say, okay, if you have 10 categories, 10 ratings loan, what is this relationship between your rating categories and the defaults which have taken place, say, in the last 5 years? So how much of the loans that you classified as 2 rated gone into defaults? 1%, 2%, 3%? How much of the loans that you have categorized as 5 rated actually went into the default? So you study the relationship between the different rating buckets and the defaults which have taken place in the history. Now, and then you study that relationship not for 1 year, but for a number of years to come up at an average possibility of default from each bucket. So how much is the possibility of default if the loan is categorized at 4 rated? 5%, 6%, 10%. So the previous realized rate of default in that bucket will tell you that this is the possibility of default for the future. But that is the history. We are using a data or relationship based on the history. The history may not be equal to the future. So what we do is we also then apply and look at the macroeconomic factor. Okay, 2 rated loans in the last 5 years, only 10% of the 2 rated loan went into default. But in the future, maybe 15% of the 2 rated loan go into default because the GDP is going down, because the interest cost is going up, because the economy is moving in a different direction, because that economic scenario is different from the previous economic scenario. So you apply certain macroeconomic variables and then make the probability of default which was derived from the history to forward-looking. So there are statistical formulas, I'll not go into those technical details, but transitional matrix approach, Markov chain method, etc. They're all well-recognized methodologies which are applied to drive the PDs. But at the end of the day, they are based on your history, how much of your loans have gone into default and how that default relates to the asset quality that you're assigning to them in terms of your credit rating system. So therefore, a bank which has low history of default will have low probability of default as well in the future. Secondly, loss-giving default is simple, that you study the relationship of how much recoveries you have made from your defaulted exposure. So you study, say, in the last 5 years, on an average, how much corporate recoveries have been made. And for this purpose, we ignore, by the way, the collateral, which are hypos, which are, the mortgages, etc., because effectively those collaterals are not realized because of the litigation process that we have. What happens is, because you hold a collateral, you hold a property, that helps you bringing the person on the table and you negotiate a cash recovery. So we are looking only at the economic recovery that you have made over the last 5-6 years, because everything is reflected in that economic recovery. For example, if the history tells you that on average on the corporate loans which have gone into default, the bank has been able to recover, say, only 30%, and 70% was a loss. So that is a good indicator, or a LGD percentage is 70%. Loss giving default is 70%. There is a Basel LGD, which is a global approximation or global average, which is 45%. 45%, which means the Basel assumes that 55% is recovered through a collateral realization process or a cash recovery process. But in Pakistan, so far, our experience is, I think that is a very high expectation. On an average, I think the banks are not, the LGDs are not 45%, but higher, I think 60-70%. So our recovery rates are not as comparable to Basel assumptions. So we cannot just straight away use the Basel assumptions, but rather have to test them against the history that we have in the bank. So a bank which has a good recovery history will have a lower LGD, which means a lower expected credit loss. And EAD, again, I think this, we just have to see that how much of the unfunded exposures that are there, and what are the chances, so the credit conversion factors are applied to come to the exposure, like you do for Basel purposes, that in case of default, how much is the exposure that will convert itself into the on-balance sheet exposures. So as you can see that, the expected credit loss is driven by your credit efficiency, through your credit management systems. If the bank is more efficient in terms of credit management, then the expectation of credit loss is lower from that bank. Whereas a bank which has not shown good recoveries in the past, where the more defaults have occurred, not efficient in credit risk management, the expected credit loss would be higher. So it is based on the economic reality rather than a similar standard or a similar formula to all kinds of situations. So in practice, in applying this model, I think in the first year, I think that there are a lot of data challenges because this is a data-intensive exercise. You need to have data around your credit rating patterns. You need to have data around your recovery history, and then how you built up relationships to develop your PDs, etc. So that requires a one-time modeling effort. But that one-time modeling effort can improve as you continue to apply the standard over time. Because first time when you apply the standard, you may not get the entire amount of data that you want to use for the purpose of developing those estimates. But next time when you apply the same standard, obviously you will have more data because you will be capturing more information so that you can use the model more effectively. So in terms of this model, the standard is not prescribing all these models. IFRS 9 is just setting out principles. IFRS 9 is saying your provision should be based on expectation of credit loss, and that expectation of credit loss, the principle is it should be a probability-weighted expectation, which means, and that's the reason why we use the PD models, because you have to probability-weighted models have to be applied. Secondly, the standard said it has to be based on best available information and backward and forward-looking both information. So it just can't be a backward-looking information, it has to be both. And then we use those principles and develop and apply those principles into PD, into LGD, into exposure default to come at the expected credit loss model. Now, in terms of if you look at the potential benefits of using this model, as I said, the credit loss would be recognized promptly rather than waiting the time till the default occurs. So the bad credit decision taken by a bank will be visible more promptly than waiting till the default occurring. Credit risk management systems will have to improve because now the risk managers will understand that rating systems that you're using have a direct relationship with the provisioning that is going into the financial statements. Currently what is happening is the risk ratings are not used for the purposes of making a provision. And therefore, the risk departments and credit risk management is taking place in isolation. So there is a financial way of making a provision which is based on a set formula or a regime which is driven by regulatory requirements. But the credit risk management or risk department of a bank, which is actually dealing with the risk, which is assigning different categories of risk, those inputs and realities are not going into the provisioning formula. So there's a big disconnect. As a result, when you implement this model, the CFOs and the risk managers have to coordinate, have to work as a team to come up with a realistic level of provisioning on the considering the overall risk of the portfolios rather than a standard way of doing a provision against only defaulted portfolio. So the credit risk systems will inherently have a potential to improve, and there will be more accountability on those credit risk managers because their ratings, their decisions are now driving the financial numbers. Then I think the lending prices, it may affect the lending because currently what is happening is we take lending decisions based on the market liquidity requirements. In some cases, banks are also lending in KIBOR or minus KIBOR in some situations because they're so liquid. So there is no consideration of the credit risk in setting the price for the credit. So now, from day one, the banks would understand then on day one they have to make provision against a certain borrower. So based on the credit risk, and that credit, if they're making, say, 1% provision, that 1% has to come from somewhere, and it has to come from the credit pricing. So the KIBOR plus should be based on the credit risk rather than only the market factor. So if all banks start doing it, so the credit risk will drive the credit pricing, so the borrowers will also understand that if I'm going with a high credit risk situation, the bank will charge me more rather than dealing all borrowers in some way the same because the market compulsions are such. So that will make the financial statements more stronger because you have already a price charge for the risk that you're taking. As I said, better credit risk management, and then obviously this model will be intentionally recognized model. You can benchmark yourself to any global bank because you're doing the same way of provisioning as compared to the international standards. The Basel is also coming close to the expected credit loss model, and I explain you how. Currently, we use in Pakistan the standardized approach for Basel credit capital adequacy purposes, but advanced approaches also have this concept of ECL, which in the advanced approach of ECL, but that ECL is slightly different from the ECL that is coming out of IFRS 9 because the Basel ECL is based on the distressed economic scenarios. It's not based on a normal economic scenario. So IFRS 9 is based on a normal economic scenario, and that is the reason it is different from the Basel ECL. But if you have a mechanics to have ECL computations for Basel, those can be used to adjust it to the IFRS 9 requirements. But important thing is that the standardized approach, even the standardized approach is now changing. And the ECL under IFRS provisions will be recognized in the standardized approach, which means that whatever ECL you are calculating for IFRS 9 purposes will directly go into your capital calculation, capital adequacy calculations under the Basel. And the Basel will recognize those ECL provisions as a valid input into the credit exposures that you calculate for capital adequacy purposes. So there, which means by compulsion, you have to make those calculations for Basel purposes, even if you do not adopt IFRS 9 for accounting purposes. So that, because the Basel is adopting the IFRS 9 ECL for this, even for their standardized approaches. So the banks have to do it, in a year's time, etc., whether or not the accounting changes takes place. So this is on the capital front. Now I think I can talk a little around what are the challenges. I think there are few areas which needs to be kept in mind. Governance, systems, policy is very important. IFRS 9 is not a rule-based standard, it's a principle-based standard. And every bank, every company has to develop models, systems, policies, procedures around it, and there has to be a team or a group which is overseeing, including CEO, CFO, audit committee, etc., which take ownership of that model, and there should be controls that those models are not abused, and those models are foolproof, are audited, have a valid audit trail, etc. So a concrete set of policies, procedures, etc. are required for IFRS 9 implementation. There are operational requirements, as I said. I think these are temporary. Anything that you do first, there are teething issues, data collection issues. I think that's something which is not bothering me. And then you have impact on the capital adequacy ratios. There will be impacts on capital adequacy ratio because what you're doing is you're increasing the level of provision, and that provision is going directly as a deduction from your capital. So certainly, there's going to be impact on the capital adequacy on day one, but many of the regulators have taken this approach that they're considering allowing some staggering of this capital adequacy charge because you're adopting a standard for the first time. To take all the burnt in 1 year may not be fair. So it may be a deferral approach depending on each jurisdiction, that whatever is the effect on the capital, if that can be staggered over 2 years or 3 years, I think that, because there's a paper of Basel which advocates that this approach, these kind of positions can be taken. Impact on NPL. The current way the NPLs are measured, we don't think is going to change much, because if you look at the NPL from IFRS 9 point of view, as I said, probability of default is 100% because the already default has taken place. Loss-giving default, exposure at default already crystallized that you know that what is the default. LGD, loss-giving default. The loss-giving default is somewhat prescribed by the percentages of provision that we are using. For some standard, substandard 25%, 50%, and 100%. If you take those percentages as a proxy or estimation of loss-giving default, because those percentages were arrived at by using some international averages. And then we also allow some FSV benefits. So if you take those percentages of provision and also allow FSV benefits, so effectively the LGDs, you're talking about the LGDs which are prescribed through a regulatory process, and by using that process, even that will be an IFRS 9 compliant. So regulatory regime around NPL provision may remain the same, but over and above stage 1 and stage 2 provisioning can be based on IFRS 9. Still, we can achieve compliance from IFRS 9. So the cost of compliance with IFRS 9, that is also obviously is going to make a huge change to your systems. Training is required to the people, that those who are handling IFRS 9, and those things would need some spending. So yes, there is a cost involved, but that is happening across the world. And also, I think some of the people have raised this question that the tax allowance, whether IFRS 9 provisions will be allowed for tax purposes. Yes, it's an issue. It has to be taken up with the FBR because currently there is a limit that 2% of the advances, etc. So far as the banks are meeting that limit, I think the state bank, the FBR should allow whatever the provision coming through the recognized accounting standards. But certainly, currently, the tax law says that provisions are allowed based on the state bank regulations. So if the state bank regulations become IFRS 9 compliant, then certainly there is a way to claim those tax provision through FBR as well. So I would say, I think the whole philosophy and mindset is changing. The provisions will be more driven by the futuristic outlook, how the risk management systems look at the risk going forward, the economic realities going forward, and the risk management systems have to be more robust to capture those realities before we implement IFRS 9. And currently also, I think we should not wait till the credit risk systems become more robust, but this is a process or evolution which takes place as you go with IFRS 9, because there is a push of IFRS 9 to make the standards more robust. Every bank would have to do it, otherwise it will have a repercussion in their provisioning, and therefore nobody would like it. So automatically, people will invest in their risk management systems so that they have a more efficient credit management to deal with, and therefore a lower charge in terms of the ECL. And as I said, I think all of us, the CFOs, the risk managers, the board audit committees have to work as a team when it comes to a very important number of ECL in the financial statements. There are a lot of disclosures which have to be made for transparency purposes in the financial statements, which will spell out the methodologies which have been adopted and the numbers which have been produced and the models which have been used, so that the shareholders can see that something which is done is a thorough job. So I think that's all from my side. Thank you so much.
Thank you, Mr. Salan Khalid, for such a detailed and insightful presentation on the IFRS 9. So now, ladies and gentlemen, we'll be moving towards the next session. We'll be calling on our panel on the stage for the next round of discussion. First of all, I request the moderator of the night, Mr. Imtiaz Gadar, to come on stage. Mr. Imtiaz Gadar is the head of capital markets at Bank Al Falah Limited, a charter holder, CFA charter holder. He has previously worked with global as well as local investment banks, including JP Morgan and KSP Bank. We'll request Mr. Salan Khalid to please also join us. I think we don't need any more further introduction for him by now. I'll request Mr. Risha Mohyuddin to please join us on the stage. Mr. Risha Mohyuddin is Global Treasurer at HPL. He's had a distinguished 2-decade-long career of the banking sector and treasuries in particular. He's worked as a treasurer for National Bank, UBL, as well as global banks like Barclays and Citibank. I'll request Mr. Abdul Wahid Sethi to please join us at the stage. Mr. Sethi is the CFO for National Bank of Pakistan. And before that, he's also worked as the Group Chief Auditor Internal Control at National Bank. I'll also request Mr. Tariq Hassan to please join us on stage. Mr. Tariq Hassan is a CRO for Mizan Bank Limited. Before taking the role of a risk controller, he's also used to be a risk taker himself. He's worked as a credit head at Mizan Bank, Askari Bank before that. And in the end, I'll call upon the most important person to come on stage, is the big brother, Mr. Syed Irfan Ali. Mr. Syed Irfan Ali is the Executive Director and Head of the Banking Policy and Regulation Group at the State Bank of Pakistan. Mr. Syed Irfan Ali has more than 2 decades of experience of working as a regulator as well as a banker. He's worked in the Banking Policy Regulation Department, Banking Inspection Department, as well as the Payment Services Department. So now I'll hand over the stage to Mr. Imtiaz Gadar to take us from here and hopefully have a lively and engaging session from here. Mics, please.
Thank you, Saqib, and thank you, first of all, Aslan, for that wonderful insight. I think we've got a very detailed insight into what the theory of IFRS 9 is going to look like. What we'll try to do with this panel is to take that discussion forward from the base that Aslan has set and see what's happening on the practical side, what is the experience of the different banks that have already gone into this, and what are they looking at, the implications, and how do we see banks going forward in light of IFRS 9. But I think before we start on that, I think what would be apt is to just have, since we have Irfan Saab here, so I think it's apt that we have the regulators' view upfront on how they are looking at this and how they are approaching this transition that's happening in the banking sector in the form of IFRS 9. So Irfan Saab, over to you.
Thank you so much, and it was a pleasure to be here this evening. Actually, Aslan ने presentation इतनी अच्छी की कि I thought कि किसी को कुछ कहने की ज़रूरत ही नहीं रही, nothing is left. But anyway, I'll just, how much time do I have? I'll just take a couple of minutes. I think one, IFRS 9, we have practically embarked on this journey. And this journey is not about just one step. It's a culmination of a number of events that have developed over the years. First, you would know we came up with the prudential regulations way back in 1992. The State Bank, and I recall I was sitting in my office in the year 97, it was 98, and a gentleman comes in, he was a banker, a very senior banker, and he said, Irfan Saab, prudential regulations हमारी banking industry के लिए नहीं है. So, I mean, this was it. I said, what? He said, हमारी balance sheets, they are forged. The decision making is relationship based. And so there isn't enough information to use the prudential regulations practically. But we said, sir, the time has come that we the bankers, better take informed decisions that are to the benefit of the people of Pakistan. And remember, at that time, we were sitting on NPLs of about 35%. And with no provisioning at all. With the passage of prudential regulations, we gradually started to mature. And in comes CIB, Credit Information Bureau, and there were some changes in the banking company's ordinance. And then comes along Basel, and we start to graduate from an inefficient banking system to an efficient or proactive banking system. And Pakistan, you'd be very pleased to know that I think we should be running the best financial system in the region at least. And the current net NPLs to net loans position is 1%. So this is the position, and compare it with 25 years ago where we were at approximately 35% NPLs of the banking industry. Now IFRS 9, आपको पता है कि IAS 39 was deferred a long time ago. हमने वो implement नहीं किया. Now, but this will not be the fate of IFRS 9. One, we are globally committed to its an international standard. And three, I think we aren't back, 90s nahi hai, 2000 bhi nahi hai, this is 2019. And the industry has now matured. So IFRS 9 is here to stay. And it is up to us and the banking industry to implement it. So IFRS 9 is, and Arsalan ne apni presentation mein he listed a number of benefits, but to me as a regulator and our team at the State Bank of Pakistan, we are very clear that post the global financial crisis, post Basel III capital adequacy enhancements, I think we the bankers are now much more educated. I guess it's now time to transform from a rule-based system to a principle-based system. So that is something that I like to hop upon as a regulator, and I would recommend it's time we start to think and stop finding excuses around rules, and then start finding faults with the laws and regulations. The reality is that the bankers have to lend, and they have a responsibility, and that responsibility is to the depositors who give them the money to lend. So there is an intermediary function that better be performed. So now IFRS 9 gives you that edge that you have to decide upfront as to what will be the fate of this loan, this decision that I am taking. And if you recall, a couple of years ago, we came up with the remuneration policy as well. So that it's just not one step that the regulator has taken. We have talked about IT governance, we have talked about remuneration, we have talked about cyber security, we've talked about Basel III, capital enhancements, and now IFRS 9. Yes, but where the challenge lies in the quality of data that we have. Well, that is something that you will have to decide. You'll have to take informed decisions. You will need data. And for that data, we can talk about it for a very long time, but I would pass it on, and you may like to ask other participants.
I will definitely come back with more data-related questions to you, but let's get down to some of the practical implications of IFRS 9. And I'll start with Risha, and it's almost an FAQ when we start discussing IFRS 9, at least in the capital market circle, is how do banks now approach equities going forward? In the equities business, the investments that you have in equities, given the recycling is not happening and everything?
Is that better? Oh. I think everyone by now understands what the impact on equities will be. So just to clarify, in case you haven't been up to speed. So basically it means that if you opt for the FVOCI, which is fair value through other comprehensive income, then you'll never be able to crystallize profits or losses on your portfolio. It'll stay below the line, it'll stay in the equity line. So that's a big change, because typically what's been happening is banks have been parking substantial amounts of equity investments in AFS, and when they start making profit, when they're in the money, they tend to be sold off, and banks tend not to liquidate them when they're making losses. That's been the practice. I wouldn't say it's a good practice, but it's been the practice in the market. So basically what we've been able to pick and choose and cherry pick our profits, okay? So that's all going away. So once it's in FVOCI, then whether you sell at a loss or a profit, it just stays below the line. So your board members, your management are not going to see the P&L tick up every time you make a profit, so-called. So it's really going to change the way we're managing the equity books. Now, in the IFRS 9 rules or principles, what it does say is that dividends can be paid through OCI. But there are two things there. One is the local regulations may not allow that, as Arslan pointed out. The second thing is that the market may not value that. So if you've made a gain and you show it below the line, the market doesn't sort of give you credit for that. And that's the problem. So there are two factors that need to be resolved. I think over time the market will adjust. But it's still a mental change in the way the market evaluates the bank's performance, because we're still attuned to how much profits banks are making.
Thank you, and I will come back on that topic, but I'll just digress to Wahid, and the question will be on this comprehensive income, that it's, as we've seen over the years, that at times the benchmark for the banks are measured can change. Like in the early 2000s, when there was this huge tax break coming every year, people used to talk about PBT growth rather than PAT growth. In the recent years, it was more about, okay, how much PIBs do you have, what duration do you have? Now, given that equities are a fairly active business in some of the banks and meaningful portfolios, do you think the market will start talking about comprehensive income a little more than it talks right now? Right now, it's like page 4 of the financial statement no one really looks at. But now, given some realized profits also showing in OCI, you think the stakeholders as well, the sponsors will also start looking at it differently?
Thank you. I would like to second what have already been said by Arsalan, that although we presently keep focused on our profit and loss, and OCIs are not that in focus, but that's not the case. OCI is part of your profit and loss, and now the focus will be more towards that side because your gains are passing through that also. The core income of the banks will now be shown in the profit and loss portion, and the other portion will be in the OCI portion. So it has to be looked together. And in the end, like as he has said, that dividend, although is driven by your profit and loss, but what you keep is ultimately kept as reserves. So your decision will be taken together on the basis of these two statements. So as far as your operating profits, core operating profits are concerned, they will be shown in your profit and loss. And you say they are also your core sort of business, but now you are putting them in your OCIs. It's also there to be looked into.
Risha, just
Angle, I think the banks who are relying more on the capital gains from equities, they will be at a disadvantage, because at the moment there's a core performance of the business and there is a capital gain which is coming out of the market performance. We are mixing the market performance with the management performance. The comprehensive income is a total performance. So the banks who are relying to make profits based on the capital gain realization in a market situation, they will actually be at a disadvantage because they will not be comparable with other banks. Because if all the other banks, most of the banks are not relying on equities. I think the portfolio size of equities as compared to the overall book is much less. But still, I think we have lots of capital gains sometimes. In this year, I think there will be a capital loss, so there will be some advantage. But we have to come out of this habit that we use market performance to our advantage or disadvantage, rather than focusing on our own performance. And I know that in case of many of the banks, the compensation structures are driven by the EPS number. So that EPS philosophy has to change, because it should take into account what is controlled by the management and what is not controlled by the management. So there is only fair.
Fair point. I'll come back to Risha on this on a slightly different angle, because you also run a book in the sense that you take equity positions on behalf of the bank as well. So while this is a valid argument that this is not core operations, but how do investors, I'm looking at you as an investor now as an investor, will you not really take into account a big change in the comprehensive income, whether negative or positive? So will the compass change for investors when they look at banks?
So again, you're talking about the equity investments. Look, I think initially it'll be very confusing for investors, because you'll be allocating capital against your equity investments. You may make a gain, but it's not showing up in P&L. So how do you value that? So I think the brokerage industry will have a big part to play in educating their clients in terms of what real performance actually means. So the slightly different metrics will need to be adopted rather than just P&L based metrics, price to book or other. P is not the only sort of leading indicator now.
Great. So moving on from investments, in the interest of time, we'll move on to the other big part of this IFRS 9 exercise. Obviously, is the ECL, and I'll go to Tariq. And the question would be that today you have a backward-looking but relatively objective criteria when you classify NPLs. Now, going to a forward-looking but a much more subjective criteria when you look at NPLs and your provisioning. So, I mean, how do you satisfy all stakeholders, analysts, sponsors, anyone who's looking at the bank, that this is now a very true reflection of asset quality of the bank?
I think as far as satisfaction by all stakeholders, I think it will come with time, basically. I think initially, probably auditors have to play a role out there, basically, because in terms of ECL, a lot will depend when every bank's their own risk rating models. So how good or bad I make my model, basically, no. I think auditors are there to check it out and confirm to that. So I think overall comfort will be over time. I don't think it will be from the day one. We can generate that kind of a comfort. But I think over time, things will get settled down.
Fair point. Irfan Sahab, I'll come to you with a follow-up question on that because as pointed out, Arslan also pointed out, this depends a lot on the model that you are following. Now, given that all banks will have their own individual models, is there any thought process within the State Bank that there should be some, I don't know what's the right word, localization or standardization in terms of how provisions are taken? So at least there is a broad parameter between which Bank A and Bank B can be compared, because right now it seems like there's so much subjectivity that it might become difficult to compare one bank to the other, and you could end up in a situation where a bank which is considered higher management quality, their accounts are considered more authentic than some compared to a smaller bank or a bank which does not have the same management repute. So any thought with the State Bank regarding that?
I think, yeah, that's a catch-22 situation. Yes, here is a problem at hand as to how to develop standardization. Now, one option obviously was the rule-based approach, which has been successful to an extent. But here we are talking about a prospective model that is IFRS 9. And yes, in fact, those of you who have been following the development of IFRS 9, we have had detailed discussions with almost all the large firms, and they have made presentations to us. And what we found was that even the large firms weren't consistent with each other. So which isn't strange. As a regulator, I find that to be part of the development. There would be some who would be better at a particular subject than other, but there was a general consensus that yes, we should go ahead and do it. One. Now, yes, we will consider some standardization and hand-holding of the financial industry. And currently a debate is going on within State Bank of Pakistan with the stakeholder that there should be some standardization. So what we plan to do is that we will be running a parallel conventional and the prospective system for some time, so as to give the banks some a good breathing space to develop their systems proactively. Now, if you guys have worked hard on the HR remuneration system, you would have done some homework. If you have been getting bonuses, taking no risk from the investment you made in government securities, then, excuse me, then you aren't there then. So it's you decide. If you have not followed the regulatory instructions in letter and spirit, you would be in deep trouble. But if you have followed the instructions and the movements on risk, that is, if you brought about IT governance, then you are actually thinking. If you brought about remuneration policies, then you are actually thinking. And if you have gone about talking to your, जो अभी हमने आपको impact assessment exercise, which has been carried out now, but if you've gone about doing that, you would be somewhere. So yes, so I do realize the predicament. Yes, that will exist, but there would be some institutions which we have already started to realize that are ahead of others. The others, and some are following. But I think the good part is that the industry has started to move. So I take positive signals from this work of impact assessment that has been carried out. So I'm pretty confident that we'll be able to achieve it, but not in a couple of years or 3 years. It may be a long journey, yes.
So if I was to take that question to maybe Wahid, that, given you're at the heart of this exercise, are the banks kind of expecting some guidelines from the State Bank in terms of standardization, or are you expecting that it will go to a completely homegrown model for each bank and it's going to be very different?
I think he has already answered that They are looking at some standardization, and there is a long way to go. As far as impact studies are concerned, this has created at least first the awareness in the banks. Now, as far as our bank is concerned, now everybody is aware of it, and everybody has started acknowledging that something is coming up. And now when they'll be lending, they have to see that there will be some impact on your equity. So this will help in pricing in future from now onward. They have already, like I've been asked a few times to have more sessions on it. It needs training. It needs further understanding. It's a new thing. And as far as we've just discussed, it isn't there. It is there to stay. We have to comply. Although there are certain things which are not easy for us at this point of time to absorb, but these impacts we have to take. As Arslan has said, that one opinion is, or one suggestion is to stagger the impact if it's too big for 2 or 3 years maybe. These are few challenges which will be coming. And those banks which were in past, who were vigilant and have taken this in account while they were lending, they might not have those impacts that much. So looking at one is backward, one is forward-looking approach. So as something you have not looked in the past, but that impact does come. Maybe now or next year, it is there. If you keep your eyes closed, it's not going to go. So this new approach, or more realistically matching rule, I would say over here, is what we are going to now implement. We'll be looking at whenever we take an exposure or our new you give or lend some advance, you have to keep in view that there will be impact coming. So we should have that certain provision set aside for it. And this will bring more stability on your profitability. Instead of your yo-yo, turnings, and like having 1 year of too much of profits and next year you are having, industries having an impact, or maybe one bank and other bank are not. This will be normalized in future. And it will require a lot of process change and systems. Like as Arslan has suggested, now CFO will be taking more role, or our risk department will be more, towards with the front offices, will be interacting more, is what is now required. Because we'll be telling or forcing them to, reprice or look into your lending rates, rather be driven just because of the collateral or the pressures or the targets. It should be more risk return sort of approach should be taken now.
So I'll just move on to a little bit of sector impact. So if I was to again go to Irfan Saab and just ask a question, that there's this fear of an unwanted outcome of this whole thing, because there's an upfront charge that the banks will have to take. So businesses like SME, where there's a lot of need for financial inclusion to be had, lending has to be promoted, the government is giving fiscal incentives. Does it go counterintuitive to that? Because banks might just shy away further from SME kind of lending because the charge upfront will also be more likely higher. So is there any thought process to counter that risk?
The pricing of these loans obviously would be determined upfront from the risk that is assigned to these loans. And if you look at the historical development of loans, the SME loans are definitely riskier than in comparison with other loans. But if you recall, about 10 years ago, the almost entire financial industry made huge losses on consumer loans. but no longer true, isn't it? Now, I don't see any bank making losses on consumer loans. And microfinance banks, almost each one of the microfinance was making losses to begin with, but right now microfinance banks are not making losses. In general, there may be a couple of them, but in general, they are not making losses. Now, where does in agriculture too, we used to make losses. Now banks are not making losses. This is a fact, this is actually happening. And by the way, guys, we have crossed ₹1 trillion in lending to agriculture. So I mean, so we are not making losses. Yes, we will be challenged as far as loans to SMEs are concerned. However, the trick or the jadoo or the mantra lies primarily in understanding SMEs better. As of now, we understand consumer, agriculture, micro much better than we used to. So the industry, I guess, did not, and maybe we are equally at fault, develop expertise in the SME sector or vendor developers who are the actual SMEs, the vendors who supply to the upstream industry. So here is an issue. To begin with, it would be a challenge, but as we start to grow our expertise, we will not suffer. So it's important that we improve our expertise of SMEs, and I'm sure we'll do better.
Moving on from the SME sector, just moving on to maybe the PSEs, the public sector enterprises, and Tariq, I'll channel this question towards you, is that there's this unique phenomenon. Obviously, when we'll be doing ECLs, there is this exposure to private sector, to public sector entities or government operations like circular debt, etc. Now, theoretically, that's a AAA credit. If you look back at the history, when you start modeling it, whether there have been timing delays, there's been borderline cases. So how do banks tackle that kind of scenario?
The government sector, specifically the government guaranteed financing, under this Ifrs 9 framework is considered as your AAA. They are into the low credit risk category, and I think that will continue that way because in spite of there are a couple of examples where government guaranteed financings have been there are instances of overdues in that, but eventually it has been either restructured or paid off basically. So I think in our local context basically it will continue to be a low risk in terms of because and it's consistent with the requirements of Basel as well. So I think it will continue that way.
And another follow-up question is relating to NPLs, the stock of NPLs. Now, the way we look at it, and what Arslan also explained, there is this more focus on looking at loans, whether they, looking at it at an early stage. So should we expect the stock of NPLs or the gross NPL ratio that is reported to go higher because of this IFRS 9, or the actual classification will not happen any earlier than it used to happen?
I think just like Arslan explained, NPLs are primarily, the stage 3 financings are NPL, and for stage 3, I think the requirements are similar to what we have today for NPLs. So I think stage 3 financing will continue to the current NPL levels. But yes, because of stage 1 and stage 2 provisioning requirements, there was a certain amount of additional provisionings required by the banks.
So would it be fair to say that the gross NPL ratio, because this is one of our favorite ratios that the market looks at, gross NPL ratio, and then what's the coverage of that? So what I'm deducing from your answer is gross NPL ratio remains the same, but your provisionings will definitely be higher now because you are taking prudent provisionings.
I guess, yes. I think Arslan added to it.
I think still, I think we will have those NPL ratios, but we are looking at two things. The NPL, which are impaired loans, and we are looking at the provisions against impaired loan and provisions against the good portfolio. Right. So the NPL ratio is fine. It's still an indicator of how much of the portfolio is stage 3. But the coverage against impaired portfolio is also fine. But what needs to be looked at, what is the total expected credit loss against the total portfolio? So if you have a total expected credit loss provision, overall provision is say 2% or 3% of the total portfolio, with a bank with a total credit loss provision is 1%. that would show that the bank is more efficient because they are expecting low losses in the future. And in times of economic downturns, etc., now what will happen is that the banks which are carrying more ECL provisions will, because the defaults provision will be incremental. So you already have a provision of a stage 2 loan, which is a underperforming loan, already have say 25%, 30% provision held against that loan, and now it goes into default, you actually have to provide only maybe 20% more. So as a result, you will have no shocks in times of economic depressions.
And
I think it's the behavior, the way I look at it as a regulator, I foresee that the behavior of the corporate world and the government would also change. I think this proactive approach of IFRS 9 would challenge the way we think and we do business. I think so. What I feel is, as a regulator, I am also compelled at times to keep my eyes closed on loans to PIA or to steel mills and others, and it's no open secret that this circular debt is because of the inefficiencies of the system. And we are all fully responsible for this inefficiency of the system. So the IFRS 9 would bring that inefficiency upfront.
Yes.
And that upfront or forthcoming, the upfront taking up of the issue would raise a number of questions for a financial institution as well as for a borrower. A borrower that has a weak history would try to improve his balance sheet, would try to be truthful. The accounting firms would again be, remain proactive to the challenge, and they would also start to ask, not closing but opening questions, not a reactive but a proactive approach. And I see the government behavior also significantly changing. As to, for example, now, maybe 20 years ago, I had rarely challenged the government. I don't think so. But now, literally, my staff and others are literally challenging them as to why are you taking this? Why is it being done? So, be it provincial, be it federal, we are challenging. So, we are changing moods of the way people think. Now, you'll be pleased that even for government nominees on the board of directors of different banks, we make sure that they are absolutely fit and proper, and no conflict of interest arises. And those directors' responsibilities are also forcing them to think. So, like I said, the regulator is forcing everyone to think and think proactively, not reactively. So, it's no longer important that what will happen in the year 2025, for example. What is important is that I am taking a decision now, and what I foresee to be the repercussions of a bad decision. So credit risk is just a part of it, I would say. Then operational, legal, and excuse me, the media risk, all of it comes into play. So you guys, CROs, have a tough time ahead. So, but I foresee this to be a very positive development. The government will have to think. Before borrowing, the banker will think before lending. So nobody wants debt loans on his balance sheet upfront.
I think this is a very interesting point. I think that because our focus because everyone focuses on the credit risk when it comes to bank, but actually if you look at the risk came from somewhere else. You had issues with your pension obligations, you had issues with your, the compliance with the law in foreign jurisdictions, etc. And those things have hit the banks in a different way. I think not expected from the credit. So, but the futuristic approach in the credit will really change things dramatically, because at the moment everyone is tuned that let's somehow protect 90 days past due. And that can be done using different techniques. You have a restructuring tool, you have different ways of doing it. So whole bank is geared towards how to protect something falling into NPL. and not looking at the risk which are already there. You just are doing it on a temporary basis. So, and for investors, I think it is a good thing because they will know upfront what exposure they are looking at, rather than surprises that sometimes something will pass 90 days. And it's very interesting when you also start, in case of, if you are acquiring an entity, in case of mergers, etc., at the moment, you look at the valuation, from a point of view of as-of positions. Now you have to look at the futuristic position, that what will be the ECL charge in the future in this bank, and how it hurt their cash flows, and etc., and valuation going forward. So it's more and more futuristic. Future is not easy to predict. It's always complex. It is always going to be on the basis of judgments. And I think we said it's going to be principle based on rule based. I would say, I think, just on a lighter note, don't take me wrong, but principle based is for people who are principle based. So I can understand that regulator point of view, and as an auditor, I think we have an apprehension that if it's too principle based, we may not find two principle based people who are dealing with it. So there has to be a mixture of some parameters and rules, so that taking into account the ground realities.
I think I'll not take long. Excuse me, but it's both a principle and a combination of the two, principle and rule based. You decide. As bankers, you decide what do you want. If you can, mix good rules which in my view should be just be there. And then comes the risk part. That you take some fundamental and principle decisions, then risk. Then you decide what the risk really is. Some years ago I bought an aquarium, and simply put, aquarium ko chalu kiya, pani dala, machliyan dali. Within 24 hours, all the fish died. And then I called in the expert. Usne kaha, ye kya kiya aapne? You weren't supposed to do it this way. You had to acclimatize the fish to the temperature of the water. You had to put in some medicine so as to the water gets disinfected, and you had to, हमने नीचे उसके वो पत्थर बिछाए, वो all those mountains बनाए, वो hills बनाई, and all of that was ridiculous, because the fish were not taken care of, And since then, I have to proactively manage my aquarium in a manner so that उसमें bacteria now. It is clean, so that is the kuch rules. But the other is the kind of risk that I have to take with that aquarium, and that is that there are certain species of fish that can't live with each other, for example. So, and I don't know whichever they are. So it's something that the risk guy has to decide. Some kuch fundamentals to lane padenge na. Some principles will have to be there. But then it's the risk part. To whom do I lend? And as the number of borrowers is increasing, kam nahi ho raha hai. The number of corporates are also increasing. The appetite, but the appetite of the government is more than that of the corporate world. So, I mean, if private sector आगे नहीं आएगा, तो government को कुछ करना पड़ेगा. So that is what is happening. However, I think we will also need to work on the stock exchanges, raise money. किसी को ज़्यादा risk चाहिए तो probably then bank के पास नहीं आना है उसको. Then he has to go to the stock exchange, वो venture capitalist के पास जाए, कुछ और हो, But you guys have the depositors' money. Sorry, that's it. Then there is no other way about it. आपका पैसा नहीं है, depositor का पैसा है, उसका ख्याल रखना पड़ेगा. Option नहीं है. But if somebody wants, then he should think about other avenues of investment where risk taking can be more than what is conventionally allowed.
I have been signaled we have time for 2 more questions, so I'll channel them to Irfan Saab. In terms of the timeline, because what is being discussed, and this is discussed a lot within the banks, that we've discussed the challenges that are there. There is this process that the banks need time to understand this, and there's also this thought process. There's been a very overwhelming 18-24 months for banks in the sense that there have been some exogenous shocks, which Arslan just mentioned. Apart from that, even from the regulatory front, this is a year where Basel III requirements go higher. We've recently had the deposit protection scheme come into play. We've had some banks being classified as systematically important. So what is the opportune time to roll this in to make sure that it doesn't get very overwhelming for the bank? So what is the State Bank thinking in terms of the timeline of implementing this, if you could share this with the audience?
The thought that is going on is that we should be coming out with some instructions, let's say by 31st March. We should be, so you guys get ready to get March में हम आपको ये कहने वाले नहीं हैं कि is it is implemented as of now. So it will be a pretty liberal, implementation process whereby we plan to run parallel systems. But I think you should be targeting 2020 to be practically on it. So, but we will be very flexible and we'll hand-holding bhi hum karenge. And we will also let the large firms, share their expertise. So we don't have to tell them, we don't regulate them. But I'm frankly speaking, I'm very impressed with the way the firms have taken up this challenge. It's fantastic. I think we can do it, but it will be very flexible.
Just one last question. I saved this for the end because this is the burning question that all the analyst and investor community has, because no one has clarity on the quantum of impact to expect. So it won't be right for me to ask any of the individual banks, but since you are sitting in that central position, you have done this first round of exercise, is there anything that you can share with the analyst and investor community, what to expect in a post-IFRS 9 world in terms of the impact on banks' capitals? I mean, it's a very open-ended question, and whatever you can share on that, I think the audience will take that home.
Vijat is sitting here laughing, so Vijat, you stand up and tell what your bank's position is. I mean, the CFOs be there बैठे. I think I shouldn't be sharing, I think, the public information, and that remains confidential. But yes, there would be some enhancement in the provisioning requirements, yes.
Is it at a manageable level?
It is, definitely. Like Arslan said, and I think other colleagues sitting here said that it cannot be something that is implemented in a year or 6 months. So there would definitely be some, deferral kind of a plan. Or I wouldn't call it deferral, I'll call it a spread out kind of a plan that would help the financial industry. But gentlemen and ladies and gentlemen, keep in mind that this is the year 2019 और हम बहुत आगे आ चुके हैं. अब हम कोई primitive banking system नहीं है by any means. We are Basel III compliant. We are fighting literally a war on FATF, and we are trying to improve the financial system together. So I'm very optimistic, in fact. But we will not roll out anything that is spectacular that you wouldn't know. It has been done in serious consultation with the financial industry. So at least Vijat would know where his bank stands. And so would all of you, so you know your banks. But it would be a challenge, but we would like it to be spread out over some years. So it wouldn't happen in one day. But it's time that you start developing an expertise on it, which I'm sure you have already. So it's about to roll out, guys.
Yeah, sure.
Just on that topic, one of the big accounting firms did an exercise for Middle Eastern banks a few months ago, and they estimated that the impact of Ifrs 9 was about 90 basis points on Middle Eastern banks' cars. So I don't know if we come in better than that or worse than that, but nearly 100 basis points car reduction due to transitioning over to IFRS 9.
And Tariq, I'll pick your brains on the last bit of this. Do you expect this to be very different experience for the large banks, medium banks, small banks, or it's fairly going to be similar, the way you look at it?
I think it's going to be a different experience for everyone because it all depends how sophisticated your risk models are, how you have compiled your data for the last 5 years and everything for that, for calculating PDs and LGDs and everything. So I think probably the bigger bank, it will be slightly easier exercise. For smaller banks, I think it will be slightly more difficult in terms of, they have to probably do a lot of more things. So it will be different exercise for everyone. And just to add on to what Risha said for Middle Eastern banks, I think I read a report on the European banks, and their average was 40 basis point for for a car hit, and the range was from 10 basis point to 150 basis points. So the range was quite big.
That's quite a big range. So it's likely to be a very different experience for all the banks,
Exactly.
locally, very diverse on that sense. I've been frankly being waved by the organizers that I'm talking too much of the mic. So I should just transfer this now to the audience. And if anyone has a question for the panel, please raise your hand, identify yourself, and you can ask the question to any of the panel members.
Assalamu alaikum, sir. My name is Asim. I am from MCB Arif Habib and the president of CFSIT Pakistan as well. I'll just take the privilege to have the first question to this esteemed panel. My just take is that when you have an expected credit loss model, do you think that it can have unintended or maybe intended consequences of banks pushing towards lower risk? So maybe banks avoiding towards sectors which like SMEs, which may actually need, or State Bank may actually want to push credit towards agriculture sector or SME sector, but because of expected credit loss model, they might be avoiding it?
Who would you like to answer that question? Is the first question.
I think if Irfan Saab and Tariq can share their views on it.
I thought I'd responded to this question earlier. One is, like I said, yes, an ECL model is bound to create such thought in the minds as to why should I be taking that risk. But that again, one is the pricing part, and then and two is the development of expertise on a particular business, and three, if the last action taken by the PTI government is about they've reduced taxes on income raised on SMEs and agriculture. So that is, all this, like I said, is part of a large plan. So all this is practically happening. So I don't think anybody should be afraid of taking decisions that need to be taken in the light of the incentive that are available.
Hi, it's Akbar Ali representing UBL Treasury. I have just a couple of questions specific directed to Arsalan. There's a lot of discussion on the equity portfolio as a whole. Just sort of enlighten us if understanding is correct. With regards to it's not just make or break, like just moving entire portfolio towards the HFT or the OCI method. It's obviously that script-wise option is available obviously under IFRS 9. And also, within let's say a big portfolio, let's say within a particular stock also, you can diversify into probably that OCI method or the P&L route. So just enlighten us on that bit. And second, with regards to the ADT1, which has become a very, very common instrument in the industry as now. With regards to the hybrid nature, it has to be sort of through the fair value methodology. But considering the market dynamics where this is not a very actively traded instrument, then how do you see that fair value methodology being worked out? Like it's going to be stale price, let's say when it's issued, it's not traded in the market, that's going to be taken care for the entire life. There has to be a model development with regards to the ECL that we do for the corporate portfolio. Thank you.
The first thing is, yes, you can cherry pick the portfolio and the scripts in terms of their classification on day one. So as far as the IFRS 9 says, as far as you deal with that classification upfront, that which scripts you want to classify in non-trading and trading at designated fair value through P&L or OCI, that you should be doing once. And this is a first time choice. Now moving forward, as the market moves, if something is classified as OCI, all gains or losses would go there. So what is prohibited is changing classifications, right? So you can do it on the implementation of IFRS 9 day one. You can take your view that, for example, a bank may be very aggressive and says, I will classify everything at fair value through P&L account. So the bank will obviously get advantage in times the markets are improving, and equally they will be exposed to the losses. Versus a bank which has taken a very prudent approach, and they will say, I am not interested in taking any exposures to losses, but also in times of gain, I'll keep them to the equity and not have it in the P&L account. So it's a day one decision. It's not manipulation of performance by doing a reclassification act. That is prohibited. The second thing is tier one capital. The problem is it's not a basic lending arrangement because they are convertible into equity in times certain triggering event occur, and which means that in terms of pricing, the holder has priced it in a way that it also have accounted for the equity conversion factor, which means that it is not equal, the return is not equal to principal and interest only, but also a compensation for the equity conversion feature. We cannot just say that equity conversion feature is very remote, something which is ignored. It is an important feature and it has an economic kind of an influence. So if you take that as a genuine feature, then in that case, the pricing you have to assume have been worked out on the basis of time value of money, credit risk, plus the equity factor, and that's why technically it is not meeting the definition of a basic lending arrangement. And in terms of the third question, I think yes, the models have to be developed, and those models have to be tested as well, and there has to be governance and controls around those models from an internal audit point of view, from external audit point of view. That is very, very important.
My question related to the ADT1 instrument. I clearly understood the cash flow concept, that obviously it's a hybrid instrument.
Yeah.
But in terms of its fair value pricing, because generally you fair value, you take the market price for the,
so
for that purpose.
Well, then you have to develop a valuation model for it.
For such instruments,
Yes.
right? Thank you.
I think Amin has a question here in the front row.
Thank you. I'm Amin. This question is for Irfan Saab. I just wanted to find out in terms of their number of circulars and regulations that basically were established when IAS 39 was there. Now that IFRS 9 is coming in, how does the State Bank plan to basically reconcile those circulars with the new accounting methodology?
I think that reconciliation is taking place in consultation with the firms, with the CA firms.
Okay.
So that is actually happening.
So there's
but if you want a detailed answer, maybe I need to have a look at each one of those regulations. But this is happening in consultation with the banks and with the big firms.
So the two specific issues that comes to my mind is the the categorization of the portfolios in HTM, HFT, and the AFS. I think it's the 2004 circular.
Yes.
And the other thing is the maximum charge that you can do on the export refinance portfolio. How is that going to have an impact?
I think they will all be they will also have to be changed or upgraded based on IFRS 9. All of them. Us har ek pe kaam ho raha hai. Right now I can't say exactly what would be done, but yes, this is the thought process. This is exactly happening, and maybe once we are out with the rollout, then ye pura saal isi baat mein guzrega jo aapne kaha. And so because we really will have to change things. Yes, that's right.
So is that going to finish by March 31st? I think that's what you said.
March 31st tak sirf we will give you a plan.
Okay.
And then we'll start to talk about the details, the finer details. Then that would be rolled out so that, as you are aware, we'll try to create a standardization anyway. So standardization ke baghair to guzara nahi hoga. So we will have to make certain standards. But the challenge is we don't want the risk-taking hat that the banks will have to put on. We don't want to take that off at the same time. But so that the balance sheets are comparable we'll have to take some standardization measures. Yes, thank you for pointing that out.
Assalamu alaikum. This is Mohammad Ibad from Nafa Funds. I think Imtiaz Sahab has asked most of the pertinent and most burning question that we, the investor community had. But just one question to Irfan Sahab from State Bank. Have you sort of, the State Bank has looked at any sort of implementation processes around the world that has happened with regards to IFRS 9 implementation that we sort of can, or the State Bank has gotten an inspiration from to replicate that same thing in Pakistan as well? Something on the basis like, I mean, it has, the IFRS 9 implementation has happened in GCC economies as well. So are there any sort of replications that can happen in Pakistan as well? Have you guys looked at those sort of implementation processes?
Yes, we have done that. My expert is sitting here. We have in fact compared with India, for example, they have already had it rolled out. It's already implemented in Europe and in the US. So it is nothing new. It has already been done. In fact, 2018 में तो सब लोग कर चुके थे. It's and so we can also do it. I mean, so we have looked at the world, yes. And whatever challenges that they are facing, hopefully we would not be facing in the years to come.
Just to get a sense of sort of implementation that can happen in Pakistan.
The most critical one then that I find is the timeline and the thought process that has gone into it. I think what they have done is that they have learned their lessons from the post-global financial crisis. We did not have a financial crisis, so we are unable to get that feel of what has actually happened. And we run a comparatively a vanilla system in comparison with the Western world. So they run a much more complicated financial system than we do. But if we compare ourselves with India, India has similar challenges to that of Pakistan, they have what is called, but they have state institutions, so a lot of their issues get pushed under the carpet, unlike Pakistan, where we run a private sector financial institution. So things can go under the carpet as far as National Bank is concerned, but not UBL or HBL or MCB for that matter. Yes, but National Bank will remain a challenge because of government owned. So let's accept that. So they will lend to PIA and National and to the steel mill because they are state run. That is why. So that's why I said that we have to Pakistan bhi chalana hai ya nahi? या PIA बंद कर देनी है. I mean, let's think through, let's be pragmatic. So we have to run our country, and as long as the government has more appetite for credit than the private sector, there would remain challenges that we will have to address. Yes.
We have time for two final questions, if there are any in the room. I think we have a question there.
Assalamu alaikum. I would just like to add a comment to Ibad Saab's question. I had a chance to look at some African banks. Usually what happens कि वहाँ के central bank ने retrospectively retained earnings से portion निकाला, P&L से pass through नहीं किया. दूसरा पहले साल में 60% और remaining फिर बाकी 2 years में उन्होंने किया. और वहाँ का जो सबसे जो riskiest bank था, जो जिसकी सबसे ज़्यादा off lending थी, उसका 8% at max कार उड़ा है in Africa में. There's the bank. Just want to add a comment to that. Thank you.
लेते तो अच्छा था, लेकिन आई थिंक ये जो आप कह रहे हैं कि equity के थ्रू तो IFRS 9 transition allow करता है, all the impacts will not be through P&L account on the implementation date, but through the equity. तो वो तो IFRS 9 का ही.
Do we have any more questions in the room? Otherwise, I have the mic. I'll take the last question. So I'll direct this to Vaisa because there's a question somebody says sent me on understanding how does the tier 1 and tier 2 get differentiated when the equity gains are booked or not booked, because everything is going to OCI, that much is clear. But is there a differentiation when you calculate tier 1 capital versus tier 2 between the gains that have already been booked and the ones that have not been booked and just been marked to market?
tier 1 में तो hello देखिए कैपिटल पे तो इफेक्ट इसका आएगा. टियर 1 में जिस वक्त आप प्रॉफिट एंड लॉस के थ्रू इसको इम्पैक्ट लेंगे तो डेफिनेटली इट विल गो टू द टियर 1. एंड और जो आपके सरप्लस वगैरह का पोर्शन है दैट गोज टू योर टियर 2.
So इस वाले मॉडल में IFRS 9 में there is no benefit of realizing gains, not even on tier 1 capital, not even on P&L. दोनों में मैं ये differentiate करना चाह रहा हूँ
कि इसके गेन्स जो बुक करेंगे
अब
थ्रू
ये जब OCI में जाएगा तो फिर everything is treated like unrealized gains, even if it's been sold and booked. Is that how it works?
No. देखिए आप अगर उसके थ्रू OCI के थ्रू भी गेन को बुक करेंगे तो वो आपके टियर 1 में ही चला जाएगा फिर अल्टीमेटली. Am I right? What I was discussing with in detail in Basel 2 perspective, it will go to the tier 1.
So Basel के अंदर ये AFS Securities का गेन tier 2 में जाता है, ठीक है ना. So comprehensive income के अंदर क्योंकि रिसाइकल नहीं होगा P&L के अंदर, so that which means के unoperated profit के अंदर नहीं आएगा, वो सारा का सारा
surplus की तरह ही treat होगा. Fair point. So thank you so much for everyone for patiently listening to this. Saqib, let's take this. Okay, so I think the jury is still out on where this is going, but yeah, hopefully we'll have clarity on this by the time we launch.
Tier 2 का मसला रहेगा because tier 2 obviously tier 2 will be an issue, you know. Tier 1 is the preferred capital. Right. So and Basel 3 does impose a lot of restrictions on what will be taken into account. Maybe हमें specifics में शायद जाना पड़ेगा just to understand this better. But हर चीज़, you know, whichever is, if it is tier 1 specific, कुछ नहीं होगा. But tier 2 would remain the challenge. You know. But I don't have a specific
answer. Tier 2 में एक available reserve है. Now you are booking that profit. So when you will route it maybe through OCI, it will go to the tier 1. To my understanding, I will recheck it further.
Fair point.
Okay. It will be in your tier 2 when, let's say, it's a surplus on revaluation, for example. Now you are booking that profit not through P&L but OCI, but it will go to the tier 1 because that's, you know, the core reserve, uska jo hai na gain, now it has been booked. So to my understanding, it will go to then tier 1. I'll reconfirm it further.
Fair point.
टैक्स इम्प्लीकेशन के हवाले से आपको बड़ा अच्छा अरसलान ने समझाया कि उनके लिए तो इट्स अ प्रॉफिट. वो दे विल नॉट अंडरस्टैंड इट्स प्योर फ्रॉम ऑपरेशन P&L, और they will say कि you are just routing it, you tagged it as your, you know, something which will go through OCI. You are trying to, they will challenge us that you've been trying to hide that profit. So they will never agree with this. We you know, sort of, they will say you're doing eye washing, you're hiding behind IFRS 9.
So I guess they'll not even allow ECL losses.
No, they will take it as your
loss के time पे agree करा लें उनसे. Loss के time पे agree कर देंगे कि
that was the point, that then ECL won't get adjusted in tax liability, your capital gains will get taxed. Fair point.
जैसे मैंने पहले कहा, the more awareness is still required. And as this awareness is already there, now उसकी testing के लिए जैसे भी हमें आपके इस forum पे हमें relaxation मिल गई, thank you to you, कि अभी 1 साल हम इसका parallel run करें कहते हैं किसी को शेयर्स की अंडरस्टैंडिंग ना हो, उसे 100 शेयर्स गिफ्ट कर दें, उसको सब पता चल जाता है स्टॉक मार्केट क्या है. सो व्हेन इट विल बी ऑन अस, और कोई भी हम बुक करे होंगे पैरेलल रन में, हम उसका साथ ही इम्पैक्ट देख रहे होंगे. दिस विल क्रिएट अवेयरनेस वेयर एसेट्स आर बुक्ड, एंड इन एल्को लेवल वहाँ पे बाकी स्टेक होल्डर्स जो उन पे चेक के तौर पे बैठे होते हैं, वो उनको उसको पूछ रहे होंगे कि व्हाट आर यू डूइंग, दिस न्यू एक्सपोजर्स यू हैव टेकन, इसके क्या इम्पैक्ट्स आ रहे हैं ऑन आवर कार, लुक एट आवर लेवरेजिंग रेशो. These things will create better equilibrium between your deposits and how you place into your advances. So the risk return will prevail ultimately, but it will take time. So this year, as we have been allowed relaxation, we will do this parallel run, and more understanding will come from where the assets are.
Let's do this panel every 6 months. So it will keep getting delayed. So thank you so much, everyone, for taking the questions and for helping us understand this more. Arslan, thank you once again for laying the whole foundation for this discussion, and thank you to all the panel participants for sharing their thoughts on the more nitty-gritties of this all. So thank you so much, and I think we'll end the panel discussion here.
I think we should thank the panel once more because, as they say, a good learning experience always raises more questions than answers. And I'm sure as we grow as professionals, more questions will be asked in terms of the assets, in terms of risk appetite of banks, with respect to investments as well as lending. And obviously, capital adequacy and taxation will also remain one of the key questions. Now, I'll just request Mohammad Asim, President of CF Society Pakistan, to just say a few words as a closing remarks before we head for the high tea. Thank you.
Thank you, Saqib. As the president of CFSIT Pakistan, I am extremely glad, I am really glad that this forum has really brought together the industry leaders and regulator together. I am really thankful to Irfan Saab for joining us here. Arsalan, as an analyst, I am not an accounting expert. However, I must say that you have delivered a very effective presentation to help us understand and take away the potential impacts of IFRS 9 on the banking sector. I would like to thank all the panelists, Risha Saab, Sethi Saab, Tariq, and I would like to thank Irfan Saab in particular for his presence. And Arsalan, thank you so much again for bringing together such a great event in such an effective manner to deliver the presentation. I would like to thank FMA President Mr. Wajad and Saqib for really helping us deliver this event, this great event, and I'm looking forward to such events in the future. Thank you so much.
Thank you, Asim. Before we close, I think we just need to make one last announcement that Arsalan has been gracious enough to allow us to publish this presentation. So we'll be placing this presentation on the FMA website, and CFA Society will also be publishing the same presentation so that all the stakeholders, whoever was here, whoever could not make it, and they want to go through it once more and maybe further broaden their knowledge, can benefit from it. So thank you very much for that. I'll just request Mohammad Asim and Mr. Wajah to please come on stage and maybe, give a bit of memorabilia to all the panelists and speakers as a token of, our thank you and appreciation. Mr. Sayyid Tariq Hassan, please. Mr. Abdul Wahid Sethi, please. And in the end, our moderator for the evening, Mr. Imtiaz Gadar. That's it for now. Thank you very much, ladies and gentlemen, for making it to the event. On behalf of Financial Markets Association of Pakistan, as well as CFA Society Pakistan, we thank you all for being here. The tea will be served in the hall, so thank you very much for being here, and hope to see you guys again very soon.